have a busy week coming up so far as data on the UK economy is concerned, with unemployment and wage growth due on Tuesday the 17th, inflation figures on the 18th, and then the latest GfK UK Consumer Sentiment Survey on Friday the 20th. The latest unemployment data will cover the 3 months to November. For the prior period to October, the unemployment rate was 3.7%, 0.1% higher than in September, while the employment rate was 75.6%, still a fraction below pre-pandemic levels. Meanwhile, the vacancy rate fell for the 6th time in a row to just under 1.2 million. The small increase in the jobless rate and small decrease in vacancies may have, in the eyes of some economists, provided further evidence of a steady slide towards recession, or at least an economic slowdown. That said, wage growth including bonuses was still 6.1% year on year, a strong number, and one that could fit with the stagflation narrative propagated by some. Tuesday's wage growth number will then be benchmarked against Wednesday's headline Consumer Price Index, or CPI, inflation figure. This will be the reading for December, and in November CPI inflation eased a fraction, thankfully, to a still scary 10.7% from October's 11.1%. Economists, politicians and central bankers will be looking for another deceleration this time around. The Bank of England will be looking for a retreat in inflation towards its 2% target so it can cut interest rates and boost the economy. And workers will be looking for a deceleration so their pay goes further. Inflation is still outstripping wage growth, so in real terms, workers are still worse off. The GfK UK Consumer Confidence figure on Friday may then help to quantify the real-world impact of these figures. The headline reading for December was minus 42, up from the lows, but a long way below the long-run average, not least because the misery index remains elevated. Devised by the economist Arthur Okun, this adds together unemployment and inflation. A drop in the misery index could boost consumer confidence and give companies which rely on discretionary spending a lift. We've already seen Next and a few others issue better than expected festive trading updates, although we're still very much on tenterhooks about some of the others. On the corporate front, the quarterly reporting season will be hitting its stride in America, and trading updates will be coming thick and fast here in the UK. Names which may be worthy of further note and indeed further research include the following, although some of these dates could still be subject to change. Rio Tinto on Monday the 16th, Experian, Crest Nicholson, Hayes and Card Factory on the 17th, Burberry, Pearson, Antofagasta, Centamin, WH Smith, Kinetic and Currys on the 18th, Sage, Premier Foods, Kieran Bacavor on the 19th, and Close Brothers on the 20th. However, the company which could just cause the biggest fuss in the week ahead is Ocado. The online grocer and self-styled delivery software and technology play is slated to release its fourth quarter trading update on Tuesday, the 17th of January. Ocado shares are down by 55% over the past year and 3/4 from their all-time high of autumn 2020. Ocado therefore joins the long list of firms that were seen as winners during the pandemic, but have since seen their shares fall from favour after lockdowns ever ended, as growth rates have proved hard to sustain and rising interest rates have taken a toll on perceived growth stocks, especially those that offer jam tomorrow but losses today. And Ocado isn't forecast to make a profit until 2025 at the earliest right now. A profit warning alongside September's third quarter update didn't help sentiment either, as Ocado flagged how customers were trading down through brands and cutting basket size thanks to the cost of living crisis, so in which the presence of Marks and Spencer branded product on the delivery platform, thanks to the 50/50 venture, may not have helped with either. Input cost inflation of some £35 to £45 million, thanks to energy and even dry ice, and investment in fresh delivery capacity have also weighed on profits, or the lack thereof. The shares have since rallied, though, after that warning, helped by the latest licensing deal for Ocado Smart Platform, this time with South Korea's Lotte Shopping. And shareholders will look for an update here and on progress at the other licensing deals in the US, France, Sweden, Canada, Poland, and others. With initial focus will fall on some hard, near-term numbers. The first is sales growth from retail, UK solutions and international solutions. Retail is a 50/50 delivery business with M&S, and third quarter sales rose just 2.7% year on year, although that did at least come after 4 straight year-on-year declines. Prices rose 5% on average, but average volumes per basket fell 10% in that third quarter. Meanwhile, UK and international solutions generate fees from retail partners who use the Ocado Smart platform for their own online deliveries, such as Morrison's in the UK, Sobeys in Canada, Kroger in the US, and Casino in France. For the whole business, the whole company, analysts looking for 4% revenue growth to £2.6 billion for the year to November. Second, analysts will then dig deeper into the retail business, looking at order run rates and basket sizes. At the third quarter stage, the order run rate was some 374,000 a week on average, with the basket size on average of £116. Basket size has begun to fall and normalise, but it's still higher than it was pre-pandemic, which was around then a run rate of £110. Third, attention will switch to profit, or again, the lack of it. Ocado likes to refer to earnings before interest, tax, depreciation and amortisation, or EBITDA, where the analyst consensus is currently for a loss of £47 million for the whole year to November, against £61 million a year ago. But that excludes, as its name suggests, rather a lot of costs. And on a pre-tax basis, analysts are looking for a loss of £425 million against a deficit of £177 million a year ago. More strategically, and finally, shareholders will look for comments upon the rollout of microsites to support Ocado Zoom, the planned 1-hour delivery service in the UK. Rollout of the OSP, where 8 of the 11 partners are now live and 16 of 58 contractually committed customer fulfillment centres, or CFCs, are open. And also ongoing capacity expansions in the UK, designed to take Ocado retail deliveries to 600,000 a week on average from the third quarter's 254,000 run rate. I hope that you and your families are all in good health and good spirits. Thank you for listening and watching, and I look forward to talking to you again next week.